Hey everyone, welcome back to Corporate Decoder Community Health Systems. Inc. or CYH just filed their quarterly report for June 2026, and I am seeing some interesting moves in their debt and divestitures. Quick note, this is not financial advice, just my take on public filings for educational purposes. They've been selling off hospitals, and that is really changing the numbers. So this is their quarterly report, an update on how the company is doing financially over the last 3 and 6 month periods. Let's dive right into the income statement. For the 3 months ending the 30th of June 2026, their net operating revenues were about $2.8 billion. That is down from about $3.1 billion in the same period last year. This drop is mainly because they've been selling off hospitals, which is called divestitures. Now, looking at the bottom line, net income attributable to their stockholders was $70 million for the 3 months ending the 30th of June 2026. That is a big drop from $282 million in the same period in 2025. For the 6 month period, net income attributable to stockholders was just $12 million compared to $269 million last year. This sharp decline is a direct result of those significant divestiture gains they had in the prior year. In simple terms, they made a lot more money last year from selling parts of the business than they did this year. Moving over to their balance sheet, which is like a snapshot of what they own and owe, total assets at the end of June 2026 were about $12.2 billion. That is down from around $13.2 billion at the end of 2025. This decrease in assets reflects the impact of those hospital sales. On the other side, total liabilities are about $13 billion at the 30th of June 2026 compared to about $14 billion at the end of 2025. Their long-term debt also saw a significant reduction, going from over $10.3 billion at the end of 2025 down to about $9.5 billion by mid-2026. This reduction is a positive sign, as it means they owe less money to lenders. They use proceeds from selling hospitals to pay down some of this debt, which is a smart move to reduce their financial risk. Now let's look at cash flows, which shows you where their cash is coming from and where it is going. For the first 6 months of 2026, they actually used about $209 million in cash from their normal business operations. That is a big change from the same period in 2025 when they generated about $208 million. This means their day-to-day business operations are consuming cash right now rather than producing it. A big reason for this shift is likely the impact of ongoing divestitures and changes in how quickly they are collecting payments from patients and insurers. On the flip side, their investing activities, which includes buying and selling assets like hospitals, provided about $1 billion in cash for the first 6 months of 2026. This is higher than the $786 million provided in the same period in 2025. This inflow is largely due to the cash they received from selling those hospitals. Financing activities, which is mostly related to borrowing and repaying money, used about $902 million in cash for the first half of 2026. This is more than the $575 million used in the first half of 2025. This increased cash outflow from financing is a bit concerning, as it shows they've been actively managing their debt. Repurchasing some of their notes, which, while good for reducing debt, it does consume cash. Let's dig a little deeper into some of the notes. This section talks about impairments and gains or losses from selling assets. For the first 6 months of 2026, they recorded a net gain of about $262 million. This gain came from selling a couple of hospitals, but was partly offset by charges for assets that were worth less than what they were sold for. In 2025, they also had a net gain of $263 million from selling hospitals. This highlights their ongoing strategy of divesting assets. Here they detail their acquisition and divestiture activity. For the first half of 2026, they spent about $53 million on acquiring some physician practices and surgery centers. This shows they are still growing in certain areas even while selling off bigger chunks of the business. This table details the hospitals they divested. In 2026 alone, they sold off quite a few. For example, Wilkes Barre General Hospital in Pennsylvania was sold on the 1st of February 2026. Selling these hospitals brings in cash, but reduces their overall revenue generation capacity. Goodwill is basically the premium paid for an acquisition above the fair value of its identifiable net assets. Their goodwill at the end of 2025 was about $3.3 billion. By the 30th of June 2026, it dropped slightly to $3.2 billion. This decrease is tied to the goodwill allocated to the hospitals they sold off. They perform annual impairment tests to see if the goodwill's value has dropped. And so far they've reported no impairment charges. This table breaks down their long-term debt. You can see their debt levels have decreased. For example, the 4.750% senior secured notes due 2031 went from over $1 billion outstanding at the end of 2025 down to $689 million by mid-2026. This was a result of them repurchasing a significant portion of these notes. This section discusses the fair value of their financial instruments. It shows the carrying amount versus the estimated fair value. For their senior notes, you can see the fair value is often different from the carrying amount, reflecting market fluctuations. For instance, the 10.875% senior secured notes due 2032 had a carrying value of around $1.5 billion, but a fair value of about $1.67 billion at the 30th of June 2026. This difference between carrying value and fair value is important for understanding market perception of their debt. Here, they discuss their lease obligations. Their operating lease costs were $63 million for the 3 months, ended the 30th of June 2026, down from $74 million in the prior year period. Now, let's look at management's discussion about the business. They reiterate that net operating revenues decreased, mainly due to divesting hospitals. Same-store revenues, which means looking only at hospitals they've owned for both periods, actually increased by 2.4% for the 3 months and 2.5% for the 6 months. This suggests the core business operations that remain are performing better. Net income attributable to shareholders dropped significantly, as we saw earlier. This is a crucial metric here. For same-store net operating revenues, they saw a 2.4% increase year-over-year for the quarter and a 2.5% increase for the 6 months. This is a good sign for the underlying business. Admissions on a same-store basis also saw a modest increase. Self-pay revenue continues to be a small percentage of their overall revenue, around 1.4% for the quarter. This means most of their revenue comes from insurance and government programs, not directly from patients. The legislative landscape is always a big factor in healthcare. They discuss the impact of the 2025 reconciliation law, which they expect to negatively affect their revenues by reducing access to health insurance and cutting federal healthcare spending, particularly impacting Medicaid. This is a key risk for them. They also mention the potential impact of CMS policy changes and ongoing legal challenges to healthcare regulations. This table shows where their revenue comes from. Medicare and Medicaid make up a substantial portion of their revenue, around 15.8% and 18.4% for the quarter. Respectively, changes in these government programs can have a big impact on their earnings. In their forward-looking statements, they list many risks, but the ones that really stand out here are the impacts of challenging economic conditions like inflation and interest rates, government healthcare policy changes, especially around Medicare and Medicaid, and their high levels of debt. They mention ongoing legal and regulatory proceedings, which is typical for healthcare companies. They state that while they don't believe these will materially impact them, large settlements could still affect results. They specifically mention a civil investigative demand from the Department of Justice related to utilization review and inpatient admissions. This section says there have been no material changes to their previously disclosed risk factors, reinforcing the ongoing risks we've discussed. This table shows they repurchased about 9,377 shares to cover tax obligations. This is a very small amount and not a significant buyback program. Looking at the financials, Community Health Systems is actively restructuring by selling off hospitals. This has led to lower reported revenue and net income compared to last year, but the underlying same-store performance shows some improvement. Their debt has been reduced, which is a positive, but their operating cash flow turned negative. The biggest risks are the ongoing changes in healthcare legislation, particularly around Medicare and Medicaid, and the general economic environment. The company is essentially trying to streamline its operations by shedding less profitable or less strategic assets. My biggest concern is the negative operating cash flow, which suggests the core business might be struggling to generate enough cash to cover its expenses, even after the divestitures. What I am actually looking for is a sustained improvement in operating cash flow and clearer signs that the remaining business is on solid footing. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.